What if the money sitting in a savings account right now is worth less today than it was a year ago? The savings account, the safest place most people were told to keep their money, is a slow financial leak dressed up as security. The average traditional savings account in the United States pays 0.45% APY. Inflation in 2024 ran at approximately 3.4% annually. That gap, 0.45% earned versus 3.4% lost to inflation, means every dollar sitting in a traditional savings account is losing ground every single month, silently, automatically, and without a single notification from the bank holding it. This is not a market risk. It is not speculation. It is arithmetic, and it applies to every person who has ever been told that putting money in a savings account is the responsible thing to do. The numbers make the problem impossible to ignore. A $10,000 balance in a traditional savings account earning 0.45% APY grows to $10,459 over 10 years. That same $10,000, subjected to 3.4% annual inflation over the same period, has the purchasing power of $7,140 in real terms by the end of year 10. The account statement shows a gain of $459. The actual financial position lost $2,860 in purchasing power. The number went up. The value went down. This is what inflation does to idle cash. It does not announce itself. It does not show up as a loss on a bank statement. It simply makes every dollar buy slightly less, every single year, until the cumulative damage becomes impossible to reverse without significantly more capital. The bank is not a neutral party in this arrangement. Banks borrow money from depositors at 0.45% and lend it out as mortgages at 7%, car loans at 9%, personal loans at 12%, and credit cards at 22%. The difference between what the bank pays depositors and what it charges borrowers is called the net interest margin, and it is the primary engine of bank profitability. The low rate on savings accounts is not a market inefficiency. It is a deliberate and profitable business decision. The alternative has existed for years. Most people have simply never been told about it. High-yield savings accounts offered by online banks including Marcus by Goldman Sachs, Ally, SoFi and Marcus currently pay between 4.5% and 5.1% APY. They carry the same FDIC insurance as any traditional bank. Deposits up to $250,000 are government guaranteed. They offer the same liquidity. Money can be transferred within 1 to 2 business days. The only material difference is the interest rate, which is 10 times higher than the national average. The math on that difference is significant. $10,000 in a traditional savings account at 0.45% APY becomes $10,459 over 10 years. The same $10,000 in a high-yield savings account at 4.8% APY becomes $15,970 over the same period. A difference of $5,511 for the same level of risk, the same government insurance, and the same access to the money, achieved entirely by switching institutions. There is no catch. Online banks operate at lower overhead than physical branch networks, which allows them to pass a larger share of the interest margin to depositors. The product is identical in every way that matters for safety and access. The rate is simply 10 times higher. Beyond high-yield savings accounts, 2 additional instruments offer similar or higher yields with comparable safety profiles that most people outside the financial industry never encounter. U.S. Treasury bills are short-term government debt instruments, currently yielding between 4.8% and 5.3%. They are backed directly by the U.S. government, technically the safest financial instrument available in US dollars, safer than any bank deposit because they carry no counterparty risk. A 3-month Treasury bill purchased through treasurydirect.gov or a standard brokerage account pays a guaranteed yield with no fees and full principal returned at maturity. Interest earned is exempt from state and local taxes. Money market funds offered by Fidelity, Vanguard, and Charles Schwab are currently yielding between 4.9% and 5.2% with same-day or next-day liquidity. These funds hold short-term government securities and are structured to maintain a stable $1,000 net asset value. They are not FDIC insured, but they have an essentially unblemished safety record over decades of operation. For money that needs to remain accessible while still generating meaningful yield, money market funds are one of the most efficient instruments available. Both of these options exist outside the traditional banking system. Neither is sold at a bank branch. Neither appears in the standard financial advice given to people opening their first savings account. Their existence is public, but their accessibility is low by default. Not because they are difficult to use, but because no institution with a financial incentive to promote them is positioned to do so. The question of where money should sit depends entirely on its purpose and timeline. Money needed within 1 to 3 months belongs in a checking account, maximally liquid, instantly accessible, held at whatever institution offers the most convenience. The yield on this money is irrelevant because it is operational capital, not savings. Money designated as an emergency fund, 3 to 6 months of living expenses, belongs in a high-yield savings account or money market fund. This money needs to be accessible within 1 to 2 business days. It needs to be protected from market risk, and it needs to earn a real yield that at minimum keeps pace with inflation. A high-yield savings account paying 4.8% currently outpaces inflation. A traditional savings account paying 0.45% does not come close. Money beyond the emergency fund that is not allocated to a near-term purchase has no business sitting in any savings account at any yield level. The opportunity cost of cash beyond the emergency threshold is significant and compounding. The S&P 500 index has averaged 10.5% annual returns over the last 30 years. A $10,000 investment at that rate becomes $27,137 in 10 years, compared to $15,970 in a high-yield savings account and $10,459 in a traditional savings account. The difference is not marginal. It is the difference between building wealth and maintaining purchasing power at best. Index fund investing carries market risk that savings accounts do not. Values fluctuate. Short-term losses are possible. But for money with a 5-year or longer time horizon, the historical data is consistent. Equity markets have never delivered a negative return over any 20-year rolling period in the history of the S&P 500. The risk of holding long-term money in a savings account, the certainty of losing to inflation, is arguably greater than the risk of investing it in a broad market index fund. The 3-tier framework that puts every dollar in its correct position. Tier 1 is the operating account, a checking account holding 1 to 2 months of expenses for daily transactions. Maximize convenience, minimize fees. Yield is irrelevant here. Tier 2 is the safety net, 3 to 6 months of essential expenses in a high-yield savings account or money market fund earning 4.5% or higher. This money is protected, accessible, and actually earning a real return. It belongs here and nowhere else until the threshold is fully funded. Tier 3 is everything beyond the safety net. Any cash above the emergency fund threshold that does not have a specific purpose within the next 12 months. This capital should be deployed into assets that generate returns above the inflation rate. Broad market index funds, real estate, or business investment. Keeping this money in savings is not conservative financial management. It is the guaranteed erosion of purchasing power over time. The 3-tier structure requires no financial expertise, no brokerage license, and no minimum investment beyond what is already sitting in a savings account. It requires only the decision to move money to where it earns what it should, and the understanding that leaving it where it is has a cost that shows up every single month, silently, on no bank statement ever sent. Drop a comment with how much is currently sitting in a traditional savings account. The next video covers exactly how to move it into a high-yield account or money market fund step by step, without triggering taxes or fees in the process.